Welcome to the Deep Dive. Today, we are really digging into the financial heart of WFAR, looking specifically at their Q3 2025 results. Our main source here is actually just the prepared remarks from their chief financial officer. So we're going to break down the numbers, look at what's driving profitability, and, check out the Q4 guidance.
Yeah, and when you look at these remarks, it's less about just pure revenue growth and more about, well, efficiency. What really jumps out is how they drove what the CFO called substantial profitability flow through. We're looking at specific metrics that kind of show how better operations turn into real gains in contribution margin and adjusted EBITDA. It's a classic operating leverage story this quarter.
Okay, right. Let's unpack that then. Starting with the Q3 results themselves. Top-line growth wasn't, explosive, but it did show some decent momentum.
That's right. Reported revenue was up 8% year over year. But maybe more importantly, the CFO highlighted the 9% year-over-year growth if you exclude the impact of exiting the German market. That's fully baked in now, and you saw growth actually pick up a bit.
And segment-wise?
The U.S. business kept that pace, up 9% year-over-year. International was solid, too, up 5% year-over-year.
Okay, and this is where that leverage really starts to kick in, right? A sort of modest acceleration in revenue leads to this huge jump on the bottom line. Adjusted EBITDA was, $28 million? A 6.7% margin. But the key thing is that it grew by more than 70% year over year.
Yeah, over 70%. That's not just a blip. It really suggests something structurally changed. And the CFO mentioned the 6.7% margin is basically a record high for them if you ignore the weird pandemic period. So the question is, how? And it wasn't just cutting fixed costs. It was mainly driven by strength in their variable profit structure, the contribution margin.
Right, contribution margin. This is where it gets really interesting, I think, because that measures their core variable efficiency. Yeah, it's gross margin minus those immediate costs like customer service, merchant fees, and the big one, advertising. So what was the number?
It came in at 15.8% for Q3. Now, that's a 150 basis point improvement year over year, and like you said, their best performance since back in 2021. The CFO was pretty clear. Structural gross margin improvements, things like better logistics, getting more supplier ad dollars, gave them, quote, a wider envelope of dollars to reinvest back into the customer experience. So essentially, they made the whole operation more efficient before even getting to the ad savings.
Okay, let's move beyond the headline numbers then and look under the hood. What were the operational drivers behind that 15.8% contribution margin? What did the spending actually look like?
Right, let's break it down. Gross margin itself was strong at 30.1% of net revenue. Customer service and merchant fees, they were pretty stable at 3.7% of net revenue. But the advertising line, that was the key driver of the leverage. It came in super lean at 10.6% of net revenue.
Wow, 10.6% for advertising. That seems, surprisingly low, doesn't it? Especially compared to where they've been historically. The CFO talked about efficiency. But is that sustainable? Are they just slashing spend or actually getting smarter?
Yeah, that's the critical question, really. The CFO did say most of that contribution margin leverage came from ad efficiency, and she linked it directly to investments they'd made earlier that are now paying off. Things that improve the mix between free and paid traffic, basically getting people away from expensive search ads and into their own channels, like the app.
The mobile app. That was a specific example they gave, right?
Exactly. Revenue from the app grew by double digits year over year, and total installs shot up by nearly 40%. App users are just more valuable. They stick around, they come back directly, they don't cost as much to acquire each time. So that focus, that's a structural plus for profitability long term.
Okay, but there was a catch, wasn't there? The CFO was careful to add some important nuance around that 10.6% ad figure.
Yes, she was. And she had to be, really, especially thinking about guidance. She noted that some of that reduction in ad spend was explicitly one-time in nature. Specifically, they ran several holdout tests in Q3. These were to fine-tune their machine learning for ads and figure out incrementality. Important tests for the future, for sure, but they kind of artificially held down the total ad spend for that specific quarter. So yeah, we probably need to see Q3's margin as an exceptional peak, maybe not the new normal run rate just yet.
Got it. Okay, shifting gears quickly to fixed costs. SOT, G&A, selling operations, tech, G&A came in at $360 million for the quarter. Keeping that number steady is just as important as the ad leverage, isn't it? It lets that contribution margin drop down.
Absolutely. It creates the sort of ceiling for leverage. If that $360 million stays relatively flat, almost every extra dollar they gain in contribution margin falls straight to adjusted EBITDA.
Right. Okay, let's move on to the capital structure and liquidity. All these operational gains, they should show up pretty quickly on the balance sheet and in cash flow. Yeah. What did the CFO say about cash?
Yeah, the cash generation was definitely strong. Cash from operations hit $155 million. Then, after subtracting $62 million for capital expenditures, they ended up with $93 million in free cash flow. And get this, that's an improvement of over $100 million compared to Q3 last year. Huge swing. They finished the quarter with a lot of liquidity, too. $1.2 billion in cash and equivalents, which means about $1.7 billion in total liquidity, a very comfortable position.
So this improved operational performance and cash generation.
Yeah.
What did it mean for their debt? They were pretty highly leveraged just a year ago.
It meant a really dramatic improvement in their capital structure, a positive one, obviously. Just 12 months ago, their net leverage was over 4 times their trailing 12-month adjusted EBITDA. Today, that ratio has plummeted down to 2.8 times. Well, it's more than a full turn of leverage reduction in just a year. It signals way less financial risk.
And they weren't just passively letting debt mature, right?
Yeah.
The CFO mentioned a specific strategic move they made.
That's right. They did an opportunistic repurchase. They spent about $200 million in cash to buy back only $101 million of principal on their 2028 bond.
Wait, paid $200 million for $101 million of face value. Why pay such a premium?
Because those bonds are convertible debt.
Ah, meaning they effectively trade kind of like an equity substitute.
Exactly. Because of where the stock price was relative to the conversion price, those bonds basically represented future dilution risk for shareholders. So the CFO framed it as this dual mandate. They're trying to cut leverage, yes, but also manage potential dilution at the same time. Spending $200 million cash basically wiped out 2.2 million potential future shares and saved them future interest payments through 2028. It shows they're thinking quite strategically about capital allocation now.
Okay, so all this strong performance leads us straight to the outlook.
Hmm.
The Q4 guidance and that commitment for 2026. What are they expecting for holiday quarter revenue?
The guidance is for net revenue to be up in the mid-single digits year over year. Now remember, that still includes about 100 basis point drag from that Germany exit finally annualizing. So core growth is still decent, just maybe a little softer than Q3.
Right. And this is where we need to factor back in the reality check from Q3, right? No more one-time ad tests, plus it's the holidays. Ad spend has to go back up.
It absolutely does, and the guidance reflects that. Gross margin is expected to be in the 30% to 31% range, probably hitting the low end because of typical holiday promotions and maybe some planned reinvestment. And crucially, advertising, like you said, is expected to go back to a more normal level, somewhere in the 11% to 12% range. That 11% to 12% is probably the more sustainable figure to think about, reflecting no holdout tests and just needing to spend more during the holidays.
Okay, so if that Q3 efficiency boost dials back a bit, where does that leave the contribution margin and adjusted EBITDA forecast for Q4?
Well, the net effect, according to the CFO, should result in a contribution margin roughly in line with where they were in Q2 of 2025, which, by the way, is still a massive improvement compared to last year, just maybe not quite that Q3 peak. So adjusted EBITDA margins are guided to be in the 5.5% to 6.5% range for Q4, and she gave a clear signal on fixed costs, too. SOTG&A is expected between $360 million and $370 million. She specifically said that range is kind of the right run rate to think about heading into 2026.
Okay, connecting this all to the bigger picture. What was the forward-looking commitment the CFO made for 2026, and how does that SOTG&A run rate fit in?
The big commitment, really the cornerstone for next year, is this. They plan to invest smartly to keep growing the business at a good clip, but, and this is key, they are committing to grow adjusted EBITDA faster than revenue in 2026. It's not just about hitting a certain margin percentage anymore. It's about maximizing contribution margin dollars and then leveraging that relatively fixed SOTG&A cost base you just mentioned. Think about it. If revenue grows, say, 8%, but SOTG&A barely grows, maybe 0% or 1%, then EBITDA has to grow faster than revenue structurally. That's operating leverage in action.
Right. So summing it all up, what the CFO laid out is really a story of improving financial health. It seems driven by real structural changes, especially how they acquire customers now with the app, plus some very smart, aggressive balance sheet moves. It feels like the days of just chasing growth at any cost are definitely behind them. The focus now is clearly on quality growth and profit flow through.
Exactly. I think the key takeaway is that these operational improvements, the disciplined ad spending, the better logistics, keeping fixed costs flat, they've created a much wider, more predictable stream of cash flow. And that gives them the confidence, to reinvest some of those dollars back into the customer experience, knowing their underlying cost structure is strong enough to ensure a good chunk of it drops to the bottom line, to adjusted EBITDA. They've kind of shifted from playing defense to playing offense again, but only where it makes clear profit sense.
We heard that firm commitment grow. Adjusted EBITDA faster than revenue in 2026. Now, given how much they already cut their net leverage this past year, remember, down from over 4x to just 2.8x, how quickly might that stronger balance sheet, fueled by these efficiencies, start to influence bigger investment decisions? Decisions that could maybe accelerate market share gains even more? Will they start pressing that advantage, maybe getting more aggressive with scale, or will they keep prioritizing paying down debt? Something for you to think about until our next deep dive.